The big breakthrough of what crypto does is the incentive-based program of you can participate in the network and make money and still believe in it, right? So it doesn't matter. You don't have to be that Bitcoin libertarian who wants to fight for total privacy and total freedom. It's not fucking relevant. It is to them, and that's their fight, and that's fine, right? Everybody has a different reason. But what I'm seeing is massive corporate adoption. I don't think anybody realizes Ticketmaster have distributed 10 million NFTs, right? All of tickets are going on to Web3. Everything. So if we want to talk about how to get to the next 100 million, it'll happen at paces we don't yet understand. There are many of these Web3 projects of corporates that we don't even know about that have put millions of people into this economy. And once you're in, you've got the wallet. Once you're in, you start thinking, okay, what else is this? What can I do? And it comes. You see, money and making money is not a use case for everybody. It's a use case for people who want to invest and want to make money out of it. I think the macro was the big thing that actually caught most of us by surprise. Not that the macro caught us by surprise, but the impact it has on crypto. You know, firstly, when you have negative real wages, people have less money to dollar cost average. It's still a retail investment market. And so then the other thing is central bank liquidity being withdrawn. And, you know, if you look at the year-on-year chart of M2 against Bitcoin, they're basically the same thing. So it tells you that as money's coming out of the system, there's less money around. So as you and I know, Mark, from macro from all these years, is that's when you figure out who's swimming without any shorts on, is that moment when there's no liquidity, somebody can't pay for the liquidity that they've been borrowing, right? So that's age old. It happened in crypto this time more than it did in traditional markets. Fine. So that, I think, was the setup. So inflation plus liquidity. So where are we now? We're in a situation where inflation has most likely peaked. From my work, I think inflation comes down very fast. So that fear narrative is gone. And that was holding back crypto. And so you take that away and the beach ball can start rising out of the water.
The biggest issue for me is that people are looking to forward price earnings ratios, even trailing price earnings ratios, without understanding that profit margins are at their highest levels in history. And profit margins are one of these things that are very cyclical, and Jeremy Grantham's called them the most mean reverting series in finance. So if you're using a price to earnings ratio and those earnings are inflated, you know, by the highest value, margins in history, you're making an assumption that profit margins are going to stay elevated indefinitely into the future. That's an embedded assumption when you're using a price to earnings metric. And so I think that's something that just people don't even consider, don't even appreciate. What if profit margins mean revert back to just a normal historical level? Well, that means we're not at 16 times earnings. It means we're 30, 40 times earnings right now, right? When you normalize for profit margins. And so that's why I say, you know, when you look at, any type of long-term valuable measure of valuations, we're at the highest, we're still above all the previous peaks in stock market history. So you can talk about what would make for a mean reversion in corporate profits. You really can't expect corporate profits to be above 6% of GDP for any prolonged period of time, because you'll get political problems. If corporations are taking a bigger slice of the pie than labor for too long of a period of time, you get political problems. And so I think that's what we're seeing today with, corporate profits have been so elevated for so long. And that's one of the things that's been driving wealth inequality, where labor has been taking a much smaller share for so long, that we're starting to see a reversal in this dynamic. And this comes back to globalization and all these things, right? What enabled corporate profits to do what they did was offshoring of labor, right? That enabled corporate profits to be so elevated because they lowered their cost of doing business. So deglobalization is also the probably making for a peak, a long-term peak in corporate profit margins that will look back and say, wow, 2022, 2021, those profit margins were literally off the chart, and we're starting to see, political movements towards that are starting to address things like wealth inequality. If you think about, what do you really need to rein in inflation? What you really need is positive real interest rates. You probably, let's just say, core CPI is going to come down to, or core PCE is going to come down, let's say 4%. Let's be generous by the end of the year. That means you need a 5% Fed funds rate. Bill Dudley has said this. You need a Fed funds rate that's positive in real terms to really address the inflation problem. We're not going to get a 5% Fed funds rate by the end of the year. But at the same token, MMT, modern monetary theory, has said you can go ahead and print money. When you get inflation, the way you deal with that is not through monetary policy. You need to raise taxes, right? And so you need fiscal policy to also work to rein in inflation. But imagine, trying to get politicians to raise taxes right now in the midst of this inflationary regime. There's not anybody in Congress right now who's even willing to go anywhere near this issue, because people are already suffering from rising prices. Deflation is the real monster. And you have, the economists tell you that inflation is dead, and Bloomberg Business Week tell you the same thing. And so there was this mindset, driven by 40 years of disinflation, that deflation is really the real boogeyman. And that's, so shifting those mindsets to really understand what the problem is today is going to take a lot of time. And it's, that's why I think we're in another, 1970s type of situation right now. We could see inflation cyclically peak here, in July. Gas prices come down, commodity prices come down. But a cyclical peak doesn't mean that it's that this inflation problem isn't done on a longer term time frame. And so I think that's what people are really betting on right now. So we'll see a cyclical peak, and inflation will come back to the Fed's target, and it'll be done. That's where the market mispricing is off. I think we're probably going to see a raise in the corporate income tax, and we're seeing a 15%. Democrats are really pushing for a 15% minimum tax. That's probably just a start, because what you understand when you look at history is wealth inequality does this for long periods of time, where it widens, and the wealthy take a greater pie, and then you either get a redistribution through the democratic process, or you get revolution.